Okay, students, we're back. We're on chapter 13 on liabilities. And before I go over the homework, I wanted to start by going over an effective interest method amortization problem. So this is one I just made up several years ago, but on January 1st, 2017, Texoma Inc. issued $10 million of 6% 5-year bonds paying interest annually. The market rate for these bonds is 8%. Determine the selling price of the bonds, and then prepare the journal entries to record the sale of the bonds and to show the payments of interest at December 31st, 2017, 18, 19, 20, and both the payment of interest and principal payment of the face amount of the bonds on December 31st, 2021, using the effective interest method of amortization of the premium or discount. Ignore any adjusting entries for interim periods between annual interest payments. Okay, first let me show you how you go about calculating everything. So here's the problem. I've just set it up in a spreadsheet. So there we have the bond face amount, which will be due in 5 years. There's the stated interest rate. There are the annual interest payments, which is just the interest, the face amount of the bonds times the interest rate. There's the life of the bonds, 5 years. The market interest rate of 8%, which is going to be the effective interest rate for the bonds. Now, how do you determine the selling price? Well, it's the present value of the bonds in 5 years at 8% discount rate, plus the present value of each of those 5 interest payments of $600,000 each. Now, the net present value function in Excel will calculate all of that for you. So when you get up here to calculate it, it is pretty simple. You put in the interest rate first, and then you put in the payments that you're going to have to make. So the annual payments, so we have the $600,000 here in F5. So we put those in for year 1, 2, 3, 4, and then year 5 you're making an interest payment plus paying the principal. So it's just going to discount all of those back at the 8% rate. So when we do that, we come up with a net present value of $9,201,457.99. That's what the bonds will sell for. So we can subtract and get the discount rate, or excuse me, the discount amount. And so here at the time we sell the bonds, before we make the first interest payment, our unamortized discount is this amount, and the net present value of the bonds would be the face amount minus the unamortized discount, or right there, which is the same as this. Okay, now our first amortization period, we are going to come up and to calculate the interest expense, we're going to take the net book value times the market interest rate of 8%. So right there you have that. O16, there is 16. We come down here to column O. That gets us to net book value times the interest rate, 8%, which is at F7. So you see F7 there. And notice I put dollar signs right there to make it absolute, so it will go to that cell every time. And so that's our interest expense for the year. Now, of that $36,116.64, we are paying $600,000 of that in cash. So the difference is our amortization of the discount. So we amortize $136,116.64 of the discount. We can subtract that from the unamortized discount from the previous year to get the unamortized discount that we have left. We can subtract this amount from $10 million. It'll give us the net book value of the bonds at that point. So now we take this amount times 8% to get the interest expense the next year. Notice the interest expense went up because the net book value went up. So that gives us our discount amortization. And notice over the 5 years, 5-year life of the bonds, the discount goes away completely. At the end of the 5 years, when we make the last interest payment, the unamortized discount is down to 0. The net book value is now $10 million. Okay, now if you want to see what the journal entries look like, here's what we do. So there's the present value. So notice I took off the cents, but we're going to selling the bonds. So we're going to debit cash for the amount of cash received. We're going to debit discount on bonds payable for the discount and credit bonds payable for the face amount. First year, our interest expense, $736,117. And let me just close that one out right here. $736,117. Notice that 64 cents. We'll round it up to $17. There's our interest expense. And credit cash for the amount of cash paid, and then credit the discount. So the discount is getting smaller. Next year, notice we're paying more interest expense, or incurring more interest expense, not paying it. We're still just paying the $600,000 face rate times the face amount, but we are amortizing more of the discount. So every year for the first 4 years, we make that same entry. Then in the 5th year, we make the interest entry, but then we also pay off the bonds. So at the end, we've amortized away all of the discount, and now we credit cash, debit bonds payable for the $10 million face value of the bonds that we have to pay off. Okay, I hope that explains the effective interest method, gives you an example you can see. I will post those up on Blackboard or D2L for you to see, and I'll also post another problem, actually a couple of problems, for you to get some practice at it. Now, you are going to need to know how to do this in Intermediate 2. You're going to cover bonds and leases in there, and being able to amortize premiums or discounts are very important for both of those. So just go ahead and close those two out. And let's go to the homework problems now. And so we're going to work first 5 homework problems, go as far as we can in this video. On October 1, Eder Fabrication borrowed $60 million and issued a 9-month 12% promissory note. Interest was payable at maturity. Prepare the journal entry for the issuance of the note and the appropriate adjusting entry for the note December 31, the end of the reporting period. So they borrowed the money on October 1st, so December 31st, that's 3 months worth of interest. So they borrowed $60 million. So when we borrow that money, what's our journal entry? Well, what did we receive? We received cash. So we're going to debit cash for $60 million, credit notes payable for $60 million. And I didn't have that set up right. Okay, then to accrue the interest, we had interest, the interest rate was 12%. Let me make sure of that, but I see it there in the problem. Yes, 12%. So we're going to take 12% times 3/12 of the year times the 60 million. That's going to give us $1,800,000 interest, and debit interest expense, credit interest payable. Okay, let's move to the next one. On October 1, Eder Fabrication borrowed $60 million, issued the 9-month promissory note. Interest was discounted at issuance at 12% discount rate. Prepare the journal entry for the issuance of the note and the appropriate adjusting entry for the note at December 31, the end of the reporting period. So it's a 9-month note discounted at 12%. So we're going to take 12% times 60 million and then times 9/12 to get the total amount of interest that's discounted out. In this case, so there we have our $60 million times 12% times 9/12 gives us $5,400,000 worth of discount or interest over the life of the loan. So we subtract that from the 60 million, and that determines how much cash we get. Okay, then at year end, we are paying 3/9 of this $5,400,000, excuse me, dollars interest. So that would be $1,800,000 to get 3/9 of that, or you can calculate interest. The principal, which was 60 million, is what we're calculating interest based on, times the 12% times 3/12. So debit interest expense. Instead of interest payable, now we are crediting the discount on notes payable. So notice up here, our interest was debited to discount on notes payable. Okay, note payable is recorded again at the face amount, $60 million. Next problem. On July 1, Orcus Lab issued a $100,000 12% 8-month note. Interest is payable at maturity. What is the amount of interest expense that should be recorded in a year-end adjusting entry for the fiscal year ending December 31st and then September 1st? Well, December 31st, we borrowed the money on July 1st, so it would be 6 months interest. So $100,000 times 12% times 6/12. That would be 6/12 of 12%. That's 1% per month. So 6% interest times $100,000, $6,000. So there you see it. $100,000 times 12% times 6/12, $6,000. September 30th would only be 3 months, July, August, September. So 100,000 times 12% times 3/12 or $3,000. Okay, our time for this video is just about up. So I'll go ahead and stop now and cover the brief exercises 13.4 and 13.5 on the next video.